Thanks very much for joining us. Let me first ask you, there's a populist concern, I would think, about giving the executive board bonuses in a year when you're posting a net loss of more than 5 billion euros. How do you justify that to, build Zeitung?
Well, so you read the papers in Germany, Matt, and we're obviously very alive to the considerations in our home market on these topics. Look, compensation overall is one of the most important management processes that we run every year. That's for the whole company and also for the management board. We gave deep consideration to our own decisions personally and as a group, and feel we arrived at the right compromise, if you like, between recognizing the costs both for shareholders and employees of the significant restructuring that we're undertaking and that we're leading for the company, but also attempting to align our interests with the long-term interests of shareholders. We think we struck the right balance both in the social environment and as responsible stewards of the company.
So walk me through how you get to this loss. 5.3 billion was the net number. I noticed pre-tax you lost 2.6 billion euros, but includes 3 billion in essentially restructuring costs.
Exactly. So our commentary is that really the loss this year, both after tax and pre-tax, was entirely driven by restructuring costs, transformation effects as we call them. And that's across a range of areas: deferred tax asset valuation adjustments, after tax, and then on the pre-tax line, goodwill impairment, software impairments, restructuring charges. That is all more or less in line with what we guided the market back in July when we announced this restructuring. We announced that we wanted to finance it from our own resources, and we've demonstrated in the first 2 quarters of this restructuring that we were able to do that. We, in fact, increased our capital ratio to 13.6%. So I see all of this is very much on track against the goals and targets that we set out. We've hit every single target, every single milestone of this restructuring. What I think is important is the message that the underlying business performance, once you strip out all of that noise that's created by the restructuring, is actually quite positive, showing stability in revenues, growth in pre-tax profit in the core bank. So we're very pleased with that result in the second half of 2019.
Are you on track or are you ahead of schedule here? Because 13.6% CET1 ratio, I notice you're getting a lot of the headcount reduction out of the way sooner than you may have planned. Does that provide a lot of upside for 2020?
Well, look, we're on track in every single metric or ahead. And where I'd say we're ahead is on the capital side. Also the deleveraging in the capital release unit. As you say, the personnel reductions have been moving apace. And with this step off into 2020, that underscores the confidence that we've been communicating to the market in the progress that we're making in this restructuring, in the decisions that we made strategically to realign, repoint the business, but also in the confidence that we think we've brought back to the company with our employees, with our clients in the capital markets. We see that in both the securities and markets, but in our everyday business and our engagement with our frontline, client officers.
An issue for the private bank has to be the negative rate situation, which doesn't look like it's going to change. How are clients dealing with that? How are you dealing with that?
So look, it's yes, our view is that the rate environment is likely to be stable in Europe for the foreseeable future, in part because the ECB will go through a strategic review that Madame Lagarde has announced. We see that, generally speaking, as an environment that is certainly better than additional rate declines. As it relates to our business and dialogue with clients, of course, we in the industry are now adjusting to a sense that this rate environment will persist for much longer than anyone had previously thought. So those dialogues are ongoing. We absolutely have to find ways to make our balance sheet more efficient, to sort of cease the practice of absorbing the impact of negative rates on behalf of our clients. That's mostly focused in the corporate business, where we've had very constructive dialogues with clients on how to manage their businesses, how to manage their use of our balance sheet in a more efficient, effective way to create something of a win-win out of our relationships with our client. That dialogue's been very constructive. On the retail side, it's mostly in a sort of a wealth management area that we would be having that dialogue. And again, I would say there it's a constructive dialogue because what we're trying to do is help our clients protect their wealth. And in today's world, if you're invested in deposits, over time that is going to be wealth destructive. So that's actually, generally speaking, a good dialogue. And when I speak to, also in the retail business, my colleagues in the front office in branches around the country, they're having that dialogue with our clients in Germany.